Welcome to the Capital News. I am your host, Alex Karitis. Today is March 18th, 2019. Thank you so much for joining me. I hope everyone enjoyed their St. Patrick's Day weekend. Hope you're all sobered up and ready to go because we got some good economic news to get into today. Some interesting things that are probably going to unfold this week. Again, remember, this is the week that the Federal Reserve meets on a policy meeting, and then we're going to find out their decision and what's going on Wednesday. So a lot to get to today. But the S&P was up 10.5 points. The Dow was up 65. NASDAQ was up 26 points, and the Russell 2000, the small cap index, was up 10 points. So nothing too crazy today on Wall Street. Again, this is typically the case when you have a Fed meeting. Everybody's sort of on pins and needles. Obviously, the crackheads in the stock market want their fix. They don't want the Federal Reserve to show any inkling that they are going to increase rates or that they're going to continue at an aggressive pace with quantitative tightening. You know, they just want a bigger and bigger hit every time something like this happens. And we're going to get into that in a second, but let me just continue with the rest of some of this basic data that I like to update you guys with on a daily basis. Oil is above $59 a barrel, so it seems that maybe the dollar is under some pressure, which it is. So is the president getting his wish of a weaker dollar, but now he has to contend with higher oil. Is he going to get back out on the tweet storm and start tweeting out to OPEC and Russia to ramp up production again? I mean, we've had that conversation because what we're seeing, at least from OPEC, is they have no intentions whatsoever of reversing course. They want to keep on with the production cuts. They want higher oil prices. So this is not good for at least not the American consumer and for this great economic miracle that the president says exists within this country. Of course, we know better. But nevertheless, higher oil prices, I mean, look, it was such a gift to have low oil prices at the end of last year and lower gasoline prices. And, you know, that's supposed to help the consumer. They have more cash in their pocket. They can go spend it, this, that, and the other. You know the theory. Of course, we had terrible retail sales in December, but, you know, never mind that. We continue now with higher oil prices and higher gasoline prices. So one would think that we're going to have some more difficulty, especially with the backset of all of the other poor economic data that continues to come out day by day. Now, to be fair, there is some mixed data. Some stuff is good, or at least better than expected, but a lot of this stuff is just as bad as expected or worse than expected, and that is outweighing the good stuff. But the markets, they're clinging to hope. Hope is not a strategy. Hope does not get you to fair value. Rationality gets you to fair value, but we don't live in a rational society. This is irrational exuberance, to coin a phrase, as is said out there by many people in the market. So I'm going to continue, obviously, to keep my eye on this stuff, but you have a president who is sort of battling himself. He wants a lower, weaker dollar, which hurts middle-income class Americans, and it obviously is going to hurt the poorer classes. And now it's going to transpire, and you're going to get into higher oil prices. This is highly predictable. We talk about this all the time. You have a weaker dollar, you're going to have higher oil. And that's what we're starting to see. So the president is at odds with himself. I hope he realizes this, because which Donald is going to win? Then we have gold. It's still above $1,300 an ounce. Again, probably on the back of a weaker dollar today. But it has been trading back and forth around that $1,300 range for the past week and a half. Silver is still above $15, settled at $15.40. And then we have the Treasury, the 10-year yield at 2.6%. 2.6%. So there was a little bit of selling in the bond market, propped up the yields to 2.6. Remember, last week we were in the 2.58, 2.59 range, which is starting to get a little bit disconcerting on some points, because I always tell you that the bond market is full of the adults in the room, and then the stock market are the kids, the frat boys, the crackheads. So there's some competition as to what's going on. You have to look at everything, but you have to look at the bond market. No ifs, ands, or buts about it. And when you look at some of the yields on other duration, not just the 10-year, but if you're out on the 3-month or the 1-year, 2-year, and such, 5-year, 7, and so on, you're starting to see the yield curve invert. And I'm going to have to do a separate segment on this with the inversion of the yield curve. But long story short, it's usually a very good leading indicator for the onset of a recession. It doesn't mean it's boom tomorrow. There's a lag, and history will show you that it's different. There's no rhyme or reason or set rule that it's 6 months, 3 months, 18 months, anything like that. But it's an indicator that the short-term risks are sort of outweighing the longer-term risks, so people are requiring a higher premium, a higher yield on those bonds if they're going to, in fact, lend money to Uncle Sam. So you get what's called a yield inversion, and you just plot this out on a graph, and it's very easy to see. It's nothing crazy or complicated by any stretch of the imagination. Basically what it is it's a negative yield between two bonds of different durations, with the shorter term duration being higher than the longer term duration. So you get a negative number. So we're going to keep our eyes on this. Now, typically, what you really want to pay attention to on the inversion is between the 10-year and the 2-year. We do not have inversion of this yield curve yet. I will not be surprised if it does come to pass, but as of yet, we don't. It's more on the shorter term bonds between the 6-month, the 1-year, 2-year, 5-year, 7-year. You have some of that, but not between the 2 and the 10. And that is highly predictive of an oncoming recession. Again, not imminent, not snap of the finger, blink of the eye, it's here, but it's something to pay attention to in the backdrop of all of the other economic data that's out there. And the other thing I would just like to explain to you guys too is when you look at the economy, the way that I like to look at it is like a puzzle. You don't look at any one piece. Let's just say it's a 1,000-piece puzzle. You're not going to look at any one piece and say, "Oh, I know what this puzzle is. I know what it's portraying. I know what the picture is," just by looking at one piece. But if you start looking at all of the other pieces, piece by piece, and you put them together and you connect them, you start to see the colors of them. And then you have to have the ability to discern what are the important nuggets? What's the important data here that I really have to pay attention to know what's going on? What picture is all of this data leading to? What's it telling me it's there? Okay, I'm starting to see some reds, some orange, some pink, some white. Maybe it's flowers. Maybe it's a rainbow. Maybe it's a field of something. Maybe it's a box of crayons. I don't know, but at least I have some color. I have some organization. And as I start putting more and more of the pieces together, I start to see what it is. So just take, for example, if you're building a puzzle, you know a lot of people are going to start with the frame, the outline. That's fine. That's good because now you got your frame, you got some sort of foundation, and you build within. But if just looking at the foundation and the frame of that puzzle, you're probably still not going to know what it's an actual picture of, what it's showing you. Important, but it's on the periphery. So those aren't the most important nuggets. But when you start to get those other pieces of the puzzle with greater detail, whether that's some of the GDP numbers, whether that's some of the unemployment numbers, whether that's bond yields, whether that's stock prices and valuations, whether that's other employment numbers, how long people have been unemployed, whether that's trade surpluses, whether that's the amount of investment taking place in the economy, how strong is the consumer, what are the debt levels. When you start looking at these more important pieces of information, you now start to put it all together and you're saying, "Oh, I know what's going on. I at least have a direction. I still might not have the full picture because there's still some pieces missing, but I have an idea of where it's going." And that's what I always talk about here. I can't give you definitive dates and times as to when all of this stuff that I think is going to happen, but I give you a direction. And I am rather positive and confident that my predictions are going to be correct, that the direction that we are headed in is not good. And at this point, there's not much that we can do. We've made our bed. We've set our course. We just have to deal with it. It's not going to be easy, not going to be pleasant. But we don't have the leadership in Washington, D.C., most definitely not on Wall Street, to tell us that there are problems ahead and that people have to prepare for this. This is just going to take people by storm, and it's going to be quite devastating, in my opinion. But that's how I put it together. It's a puzzle. So, I get here on this podcast. I read off some quick data points, what's going on in the stock market, what's going on with oil, gold, silver, maybe the VIX, depending on how volatile the day might have been, the Treasury, those types of things, because it's important. And then if there are some data releases regards to GDP or housing or unemployment, we get into that sometimes. And depending on how important that piece of information is, to me, I relay that to you guys so that we're all on the same page and so you can have an understanding as to why I focus on these certain pieces of information. And as the podcast grows and as we continue along, you'll see why I do what I do. And if you think I'm crazy, you can say I'm crazy. That's fine. But I'm going to continue doing what I'm doing because it's been good to me in the past. You can check out the book, my book, The Cynic's Guide to Investing, published 4 years ago. And you look at the trends and the things that we talk about and what we predicted and analyzed, the same pieces of information that I focus on this podcast, and you're going to see that those predictions, the vast majority of them, came true. They came true. This isn't rocket science. You just have to know how to put the pieces together, how to be objective, do your best to remove emotion, which is sometimes difficult for me as well. We're all human. Sometimes, you have your bias. You want to be right, and you want to be right now. Sometimes you got to wait. Sometimes you have 20/20 vision. Sometimes you have 20/15 or 20/10 vision, and you really see over that hill, but it looks like it's staring you right in the face, but in fact, it's over the hill, and it's going to take some time to actually see what transpires. But nevertheless, having that vision and having the ability to see it and make sense of it is very important, whether you're managing your money, somebody else's money, or you're just interested in knowing what's going on in the economy, because what goes on in the economy is going to affect our politics and how we vote and how we make decisions. So you have to be educated and informed to understand, quite frankly, that the system we have in this country is not free market capitalism. It is a disastrous and disgusting hybrid of fascism, which is corporatism. It simply means the government is joined at the hip with major corporations, with a nasty side of socialism. That's what we have. Are there some pieces of free market capitalism here and there? Maybe, but not too much. But you bet you know what? If and when this thing collapses again, free market capitalism is going to get blamed, when in fact, free market capitalism has nothing to do with this. Nothing whatsoever. Pocahontas, Bernie Sanders, they're going to say it's free market capitalism's fault, when in fact, it's their policies of socialism and fascism which is causing it. It's all a matter of definition. Again, it's in the Cynic's Guide to Investing. We state our case. It's all there in black and white. All there in black and white. I'll challenge anybody, any debate on it, any day, anytime, anywhere. It's just that important. You want to have a conversation? Let's make sure we're all on the same page with the same definition. It's that simple. Don't get hyperbolic. Don't exaggerate. Don't get emotional. Don't get emotional, Bernie. Calm down there, crazy Bernie. We'll be okay. Free health care for everybody. But I digress on that. But again, understand that all of these pieces are a piece of the puzzle. And when you put them together, it paints a picture. And if you can start to really see what that picture is going to be before it really comes to fruition and you have all 1,000 pieces there, well, then that allows you to make some moves to get ahead of the curve, get ahead of the trend, and start investing to make profits before the herd gets there. See what I'm saying? So that's how it all makes sense. Now, some economic news that I want to get to that has to deal with some global stuff. Japan trade balance swings to surplus, so that's some good news for Japan, but we'll get into some other stuff. So Japan posted a trade surplus of 339 billion yen in February compared with a $14 billion deficit a year earlier and market expectations of 310 billion yen surplus. Exports declined for a third straight month, while imports dropped the most in over 2 years amid weakening global demand in the ongoing U.S.-China trade dispute. So there you have it. Some mixed news, but exports declined for a third straight month, while imports dropped the most in over 2 years. Now you have to understand, Japan is a exporting machine. That's what they do. That's why the Japanese yen, despite that they print it in amounts like it's going out of style because it's still seen as a safe haven because one of their, depending on the country, you might have a twin deficit, which is a government deficit and then net exports deficit as well. Japan, they have a huge government deficit and huge debts, but their trade surplus is usually in the black. It's usually positive, so people view that as a safe haven if they want to go into the currency. Again, it's all a matter of relativity. What's sort of the best looking girl at the dance type of thing? That's what you look at. Yeah, the US dollar might be a safe haven. Japanese yen is quite often seen as a safe haven. The British pound, we have the Brexit noise, so that's back and forth. You have the euro, there's a lot of uncertainty there. The Australian dollar, the Canadian dollar, they're really not big enough to really be viewed as a safe haven asset. So you only have so many houses to pick from. And it's usually, when you come to a safe haven, it's usually the US dollar, Uncle Sam, and the Japanese yen. So that's some news from there. But again, they want to blame the US-China trade dispute. Again, there's some truth to this, but it's overhyped and it's overblown in my opinion. And then we have some other news. On the home front, U.S. home builder sentiment below forecast. So the NAHB Housing Market Index in the United States was unchanged at 62 in March and below market consensus of 63. So just slightly below, but nevertheless below. The index component that tracks views of current sales conditions rose to 68 from 66 in February, so that's good. And the gauge of home sales over the next 6 months advanced to 71 from 68. So again, good news. Meanwhile, the measure of buyer traffic fell to 44 from 48. So that's not good news. So a mixed bag on the U.S. home builder sentiment forecast and readings there. Again, across the pond, a little bit further down under, I should say, the RBA, that's the Reserve Bank of Australia, sees considerable uncertainties on economic outlook. Well, I mean, maybe they're paying attention to the capital news. I've been talking about this for months, since this show started. And I mean, a month and a half is when this show started, going on 2 months. Almost from day one, I've been talking about this. What are some of the market risks? Well, most certainly it has to do with Australia and the housing market. And now we see, again making news, Australia house prices fall more than expected. Whose expectation? Who's not paying attention to the data? I don't even live there, and I guess I have a better insight as to what's going on over there. More than expected, in the RBA, the Reserve Bank of Australia, which is their central bank akin to our Federal Reserve, sees considerable uncertainties on economic outlook. Well, it has a lot to do with their housing market. I mean, these people, these Australians, have debt up to their eyeballs and beyond. Some of their real estate markets in their bigger cities, Sydney, Melbourne, are some of the most overvalued in the world. I mean, only outpaced by a couple other cities, maybe Vancouver in Canada, which is terrible, Hong Kong. I mean, it's just up there. It's just, they are in the midst of a big problem, because you have a world that is awash in free money. This is what you get. It got to go somewhere. It has to go somewhere. And then you have a lot of foreigners. You got a lot of Chinese who are trying to get their money out of China. Why do you think that is? You think they trust that government? The smart people with the money, they know to get it the hell out of China, because if something happens, the Chinese are going to close bank accounts. Nope, there's no capital flight. Nothing is leaving the country. We are locked in. Well, at least if they have assets outside the country, they're theirs. So that's what they're doing. And the Chinese, with a lot of money, are going to Australia, buying up houses. They're going to Canada, buying up houses, going into California, into New York, buying up real estate, Florida, all over the place, bidding it up. That's why I told you, you're going to start to see the cracks this time, not from the subprime, but from the top tier. It's going to crack. And then once everything else starts to cascade, the bottom is going to get messed up too, and it's going to be a top-down, bottom-up squeeze. Because once the layoffs start coming, it's going to get nasty. It's going to get nasty. So that's some of the news around the world. Again, not pointing in the right direction. But who cares? We live in the land of Oz. I'm sure the markets will all be rallying to new highs very soon, because that's just what they do. Now, getting to this Fed meeting, the Federal Reserve, the Federal Open Market Committee, which is the committee that sets interest rates and will deal with the Federal Reserve's balance sheet as to whether or not they will make a decision with quantitative tightening or maybe even reverse and do some quantitative easing. I doubt they will reverse course and go and become more dovish and do quantitative easing. It's all to be expected that they will hold rates where they are, that they will continue with whatever current trajectory they are with their balance sheet runoff, that nothing's going to change. That's the expectation. And for the most part, I would probably agree with that. You have to remember the Three Stooges were out on 60 Minutes, not this last Sunday, but the previous Sunday. That would be Chairman Jerome Powell and then the former Chairman Janet Yellen and Ben Bernanke. It's interesting to note that Alan Greenspan, the even former Chairman of the Federal Reserve, was not in attendance because he's still alive and kicking. Why wasn't he there? Well, I suspect, I have my reasons. He wasn't there because he doesn't agree with them. Janet Yellen, Ben Bernanke, Jerome Powell, they think everything's fine. At least that's what they say. I don't believe they actually believe that, but that's what they say. And of course, you just get on 60 Minutes, one of the biggest, news programs, to say everything's fine. I don't think so. Call me cynical, but I just don't think they come out to tell you everything's fine. If everything's fine, there's no reason to tell you. So I have my suspicions on that. But Alan Greenspan, he publicly disagrees with them. He thinks we're going back to a 1970s stagflation, which is just a combination of the word stagnant, so there's no growth, or very little growth, or, maybe just a little below, maybe just touching negative territory, and then coupled with inflation. So that's not a good combination. Not a good combination. And for those of you listening, I'm sure, obviously, this was before my time, but you probably have a good recollection of the 1970s and how that economy was. You had a bad stock market sell-off. You had inflation. Huge problems in that economy during that time. And that's what Alan Greenspan, and he was very much alive and well during that time period. So that's very much in his memory as to how that plays out. So you have some people who see stagflation of the 1970s, and you have some people who go back even further to the 1930s, early 1940s, because given the combination of income inequality, levels of debt, that type of thing, a lot of people go back even further, and that was in the midst of the Great Depression. So, you're looking at some pretty intelligent people here whose job it is to monitor the markets, either from the perspective of an economist like Alan Greenspan, or some other people like a Ray Dalio, a hedge fund manager, who sees it going back to the 1930s and 40s, who makes a living in the markets. Pick your poison. Neither of those two time periods was good for stocks, good for the overall economy, nothing like that. So it's not just me saying it. I do my homework and I try to listen to some people. Again, you listen to them, not necessarily to form your opinion, but to sort of see how your opinions fare against other people's. Because if you go out and you listen to everybody's going to have a different opinion. So you'll go crazy listening to everybody. That's why you got to hone in on a few voices that make sense and then sort of test what you're thinking against them and see if you're on the same page or where you differ. And it's fine to differ. I hope you differ with me. But at least make it a rational argument why you agree or disagree. That's all I say. But regardless of what you're looking at, 1970s, 1930s, and 40s, it's not good at all. Now, one of the interesting things, and this is just pure speculation because it would be some interesting TV, because you have to recall, fourth quarter, 2018, when the Federal Reserve did a 180 and you had President Trump out there tweeting and giving some press conferences and answering some questions in regards to the Federal Reserve being crazy. What are they doing? Increasing interest rates. Are they nuts? What are they doing? And injecting himself into what is deemed an independent agency. Of course, the Federal Reserve is anything but. It's highly political. But you don't usually see it that transparently with a president discussing openly what he wants the Federal Reserve to do. But that's Trump's style. Love him or hate him, that's what he does. So now, and however you want to look at it, the Federal Reserve acquiesced, either to market pressure, to Trump, to whatever the case might be, they caved. They did their policy 180, and we've been on a V-shaped recovery since. Now we're bouncing off some technical levels back and forth, looking for another catalyst. The markets are hoping for some positive news of any kind because they're shrugging off all bad news. They're just shrugging it off. They couldn't care less. Couldn't care less. They are clinging for something positive, and they are hoping, beyond all hope, that Chairman Powell on Wednesday comes out during his press conference and says, basically, we're more dovish now. We're more dovish. And then you'll see this thing rally several hundred, if not 1,000 points. I don't expect them to become more dovish, but that's what the markets are hoping for because they're looking for some sort of catalyst to just propel this thing to new highs. That's what they're looking for. Again, hope is not a strategy. But it would be interesting television if the Federal Reserve made it political and said, you know what? President Trump says everything is great. Economic miracle. The Federal Reserve has a dual mandate. Low unemployment, stable prices. Check, check. Therefore, we can hike rates. You see what I'm saying? They could do a 180. They could make this political and give Trump what he doesn't want. Or at least that's what he says he doesn't want. He doesn't want higher rates. He wants lower rates. He wants the funny money. When he was candidate Trump, it was funny money, and it was a bubble, and it was a fake, and it was a mirage. But now he's President Trump, and he wants the funny money. I thought he was there to drain the swamp. So which is it? So I don't expect this to take place. Again, that's just speculation. It would just make for good TV. But imagine the Federal Reserve doing that, saying, well, you know what, look, we have a dual mandate, low unemployment, check, hasn't been this low in decades, stable prices. They tell us inflation's below 2%, so that's stable as you can get. So check, check. The stock market's back where it was during the fourth quarter of 2018. Triple check. And we have a president who says this is the best economy ever. Check, 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 check. So why can't they increase interest rates and keep their quantitative tightening on autopilot? Seems to me they can. They check all the boxes, and we're in the midst of an economic miracle. Think about it. How exciting would that be to see the Federal Reserve versus President Trump? Just think about it. But I think I'm going to wrap it up here today, ladies and gentlemen. Thank you so much for joining me. There was a couple other things I wanted to get to. It's nothing breaking or pressing. It's definitely going to take some time to explain those things. It's basically going to be another follow-up to the corporate debt market, but this time I want to get into some of the commercial and industrial loans just to show you the true size of debt that we are talking about on corporate balance sheets, whether that be corporate bonds or these commercial and industrial loans. It'll make your head spin. It'll make you understand why this is such an important piece to the economic puzzle that I'm talking about. And I'm going to get to that hopefully tomorrow, and we'll have a good discussion on that. So again, thank you so much for joining me. It's been a pleasure having you. Please like, share, subscribe, get the word out. Leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Koritis. Godspeed.